5 o'clock this morning.
I'm still here, you guys. Hold on. Okay, but anyway, while I'm like fixing my screen, this week has been a mess in the markets. So you know how like if you're walking in the dark, or how if a person is walking in the dark and something scares them and they kind of jump, whatever, they react to whatever it was. Any little thing that happens after that, if something touches them, if they hear something, whatever, they're kind of spooked. That's what's going on in the markets. It's like the best way I can describe it to you. A lot of people don't know what to do. They're scared. They are just kind of out right now trying to protect their money, protect themselves. And anyway, we'll talk more about it from that perspective at the end. But I finally got this thing to work the way it's supposed to. Okay, so yesterday the Fed finally released this paper on the central bank digital currency. And anyway, this paper, they repeatedly said that it was here to open a discussion about the Fed, them actually releasing the paper. If you know nothing about the Fed, how the Fed works, how money works, it's 40 pages, but it's definitely like one of the best places to go and find out about the Fed, how the Fed works, why the Fed does what it does, how money works in the United States, how banking works in the United States, how card services work in the United States. So if you understand none of that at all, like this is the perfect place to go. Because they literally tell you everything. They have to be like super transparent with how the monetary system works in the United States in order to even tell people how this currency is going to work. So it tells you that on page essentially 1 of True Text, how the Fed system actually works, and they perform 5 key functions to promote effective operation of the United States economy and more. So anyway, we always focus, when I talk about the fundamentals, we always focus on this very first key point, which is the nation's monetary policy to promote maximum employment and stable prices in the United States, essentially interest rates and jobs. So that's literally what we talk about a lot. But there are other things that they also do. They help, go through and measure and assess systemic risks. They monitor the whole financial system, the institutions within the financial systems, payment systems, settlements of those things, and interactions between institutions and governments, government to government transactions, also just researching the latest trends, economic developments, how banking is working in each economy. So this paper also focused on the underbanked, those who don't have access to banking services at all, because that is part of the Fed's mandate. It's one of the last mandates on the list, but it's definitely a very important one. So table of contents, there's a lot of blank pages. So literally between each section, there's a blank page, and then the last 3 pages are like references. So it's a short paper, which I highly recommend that you go through and read. I'm just going to sort of touch on some of these points and then sum it up for you. But essentially here it's talking about how in order to truly have a monetary system, a currency system in a country, you have to have the confidence of the people. Whenever it comes to that, the Federal Reserve helps to maintain that confidence and helps to implement things, whatever those things may be. They help to implement those things to help the system stay reliable and help to keep confidence in the system. So this paper often refers to stakeholders. So between the Federal Reserve and stakeholders. So I highlighted stakeholders in a different color because stakeholders in this paper is going to refer to American citizens, but it's also going to refer to the institutions as well. This paper, they are actually encouraging the public to give their opinion on how the Fed should go about creating and implementing this central bank digital currency. Or currencies, depending, because they're trying to look at this from a very broad standpoint. So for the sake of this paper, a CBDC, the central bank digital currencies, is defined as a digital liability of a central bank that is widely available to the general public. So it's going to be analogous. It's going to be essentially the digital form of what we hold as paper. So they go through a little bit of the history of payment systems in the United States. I know of some people who use their credit card, their debit card, or they might process a payment online. They don't know what ACH is. They just know that the money came straight out of their bank account. I'm like, how don't you know? But ACH is like the digital form of a check. And the Fed actually came up with that system in the 1970s. They've always been looking for ways to help make payment systems more fluid and to flow better in the United States. They have come out with this, or they've been rolling out slowly, this Fed Now service. It's going to completely come out in 2023, which is another reason why the IRS is like changing up the tax rules and like doing all this stuff. That's why 2023 is such an important year for money, for the IRS and for taxes. So they're trying to roll out this service. So essentially what's going to happen with this service is that when it's time for someone to get their Social Security check, a SNAP or WIC benefit, stimulus check, a tax check, refund, whatever, you're literally going to be able to get it directly to an account. Whether that's a wallet or whether that's your bank account, it's going to be able to be sent directly to you in real time with no wait whatsoever. That whole system where you have to wait 3 to 5 business days, you got to wait for it to leave a bank, clear, be received at another bank, clear, and then be in your account ready for you to use. Like, no, that's all going away. It's literally going to be like, if you want to take money out of your retirement account, your 401k, your trading account, whatever, you can do that. And literally the money will just show up. No wait at all. So that's the background. That's where they're going. That essentially kind of sums up somewhat of like these next 3 pages. But they talk about the ushering in of all these mobile payments. Also, they talk about what a CBDC needs to be able to do. So they highlight like 6 points that it needs to be able to do. So it needs to be able to provide the same benefits. It needs to be able to have essentially more benefits than an alternative method. It needs to complement or replace current banking systems, provide protection, privacy for the consumer, but then also have the same protections against criminal activity, broad based system that can be used between citizens and financial institutions, between businesses and financial institutions and the government, and then the government to government. So it has to be able to flow between all of those entities and different levels of finance. So this paper talks about existing forms of money, current payment systems, public outreach. This is there again where they're wanting people to actually contact them and say, hey, like, this is what my opinion is of what you're trying to do. They go back again and define what a CBDC is going to be and give you an example. They also talk about how there is a wide range of benefits. It could benefit households, businesses, as a convenient electronic form of central bank money. So it's going to define that later, but there are essentially three types of money that flow in the United States, and citizens only have access to one of those. But it's going to provide an electronic form of central bank money, the coins, the currency that we hold. And it's going to actually provide that with adequate liquidity. It's going to give entrepreneurs a platform to be able to create new financial products and services, and then also provide faster and cheaper payment methods, and then just be able to expand the consumer access within the financial system, period. It also talks about the risk. And then, let's see. So the risks that it highlights are essentially the structure, how it would affect the structure, the foundation, essentially, of the financial sector, the cost and availability of credit, safety and stability of the financial system, and then the efficacy of the monetary policy system as a whole. So they just highlight that this would be a highly significant innovation for American money if and when this does happen. I didn't really highlight and feel like some of that other stuff was important, just because they start to really become repetitive in this paper about why the Fed is doing this paper. They repeat over and over again that it's just to lay the foundation and start the conversation. But again, like I said, if you don't know anything about how the system works, this is a great paper, especially this page right here. This is page 5. So this page actually talks about the existing forms of money in the United States. So it really should say existing forms of money and currency, because often those two terms are confused. One is more valuable than the other. But for the sake of just going through this paper, getting it done, we're just going to call it all money, but just know that money and currency are not the same thing. All right, so money serves as a means of payment, a store of value, and a unit of account. So in the United States, this takes different forms. So central bank money is liable to the actual central bank. So this is what gets printed. This is actually, and see, they used the other word. They said currency. So it comes in the form of physical currency. So it's the actual paper notes, it's the coins that we use. This is the only form that citizens have access to. Commercial bank money is the digital form of money that's most, okay, sorry, hold up. This is the one that's most commonly used by the public. So central bank money is the actual physical form. It comes from the reserve and it's held by banks. Commercial money is what citizens actually get a chance to use. And then non-bank money is essentially what's held in apps. So non-bank money would be like let's say you're holding a balance on Cash App or PayPal, any app like that where you're holding a balance, that's non-bank money. So this paper doesn't talk a lot about it. Well, it doesn't talk about it at all, but it references a paper that does. One of the things that happened in 2008, and one of the things that comes up later on in this paper as a fear, is the stability of the monetary system. So the stability of the monetary system was in trouble in 2008 because of this one right here, non-bank money. So you can go through and look up shadow banks and what happened with the shadow banking system in 2000. It started happening in 2006, carried over into 2007, and then that's when we really started having the issues that pushed us downhill in 2008. Also, around that same time, we had interest rates going up, which was another mandate of the Fed. So the Fed is really trying to, in this paper, show that they're taking the steps needed to make sure that they put American citizens in a good position to have this currency, use it, and it be something that can keep the financial system stable in the transitional process between the two. So you might wonder, like, well, why all these different types of money? Each level of money that they talk about has a different level of risk. It also has a different level of liquidity as well in the system. So they're quick to distinguish the money, and they're also going to later talk about, the financial system, how all of these different forms add up. Also, we talked about it a little bit on the last Zoom call, but the FDIC, also the credit unions, essentially have that insurance. That was another risk that is talked about later, but they do go ahead and start talking about the FDIC and the National Credit Union Administration's insurance early in the paper. I will actually put the link for this document in the group chat. This one I've like scribbled and put highlights all over. If you want this one, I can put this one, but I'll put a clean one also in the group chat so that you can have it. So payment systems in the United States, they rely on interbank payment services. So there again, just what I was saying earlier, you have third-party services, you have banks that have to communicate with each other in order for the payment system to flow seamlessly in the United States. And as we know, sometimes that works and sometimes it doesn't. It flows more seamlessly now than it did in the past, but this is having CBDCs is a thing that could help alleviate some of those problems, and the Fed actually goes into a lot of detail talking about that on later pages. So recent improvements to the banking system. This is where I mentioned that FedNow service that's going to be debuting next year. Instant payments. This is going to be instant payments to household and businesses around the clock, every day of the year. Doesn't matter if it's a holiday, doesn't matter if it's Sunday, doesn't matter if it's 2:00 in the morning, 3:00 in the morning. So, when you go to your bank's website at like between 2 and 5, and they're like, oh, we're doing maintenance, quote unquote maintenance. You won't get that. Like literally, you'll just have your money whenever, you'll be able to see it whenever, do whatever you want to with it. Dang it. All right. So here, some of these new payment services could pose financial stability, payment, integrative system, and other risks. So it's actually here talking about some of these digital payment services, mobile services, and the risk that goes along with it. And then also some of the benefits. So, and going to that last bullet point that we talked about earlier on page 1, essentially, of the Fed's mandates. This is one that kind of hits at why creating a CBDC would be so important. So every time the Fed has talked now for the last 6, 12, the last 17 times that the Fed has talked, they have mentioned this. This is the underbanked and the underserved populations for banking in the United States. So they highlight that more than 7 million people, or 5% of US households, remain underbanked. Nearly 20% more have bank accounts, but still rely on more costly financial services such as money orders, cash checking services, and payday loans. So the Fed is hoping that this will help to kind of mitigate a lot of that risk that flows in the markets, where people who are underbanked or people who don't have access to the broad range of services that they can offer, like people aren't able to really take advantage of that. And this system is hopefully going to solve that problem. It also talks about how there are private sector and public sector companies right now currently working on trying to solve those issues. The federal bank in Atlanta is one. I only highlight this because we know that currently they're trialing a universal basic income in Atlanta right now. So I highlighted that because this is kind of like going into that same realm. If you actually how they're going to deliver this money and what they plan to do to track it, you know that this is like the testing of the waters for the CBDC. Also, they're trialing this as well in New York. So Atlanta is like number one. New York, they're trialing it near Washington Heights. So that will be area number 2. And that will be overseen by the New York Fed, the largest Fed, the most important Fed branch. So this section is definitely important in them trying to overcome the challenges of the system. Also, another challenge in the system is the cost. So if everyone on this call has done a transaction in cryptocurrency, we know different cryptocurrencies carry different transaction fees, gas fees, depending on what's going on during the day, what time of day, blah, blah, blah. Transaction fees vary. Transaction fees are a little bit more stable in the currency market. However, transaction fees are high as well in the currency market. You might not necessarily see it as being high, but when you start transacting money internationally, so it's talking about cross-border, international, essentially same thing. Those payments are high. It references a paper that talks about this. And one of the goals of a CBDC is to make it so that you're not paying through Western Union or RIA or World Remit or whatever international payment service you can think of, paying high transaction fees to get money sent, even amongst citizens that have to transact money, trying to mitigate and trying to lower the risk that the person is taking on having to pay fees. All right, moving on. Digital assets. So this really talks about the heart of the innovation that has happened in the recent years. It talks about cryptos. It talks about stable coins, the incarnation of stable coins, what stable coins are. They're pegged to the US dollar and are used to facilitate trades of other digital assets. So they've explored the use of stable coins. We've heard Janet Yellen talk about stable coins. Her and Jerome Powell, the last time that they were together, talked about stable coins. They also talked about cryptocurrencies. So before I scroll on, one of the points that they bring up is that many cryptocurrencies come with a significant energy footprint and make consumers vulnerable to loss, theft, and fraud, which they also talk about more later whenever it comes to the stability of the financial system. I tell you that now, and I keep telling you about later pages because I'm probably just going to scroll past it because I don't feel like reading everything, which is why I'm going to post the link in the chat for you guys to read it. But the president has a group that he's formed, and this group has presented to Congress a lot of recommendations. So they want Congress to essentially go through and like regulate, put legislation into place for all these different things. And some of it's good, some of it's been kind of questionable. Like when you start to look at why we do things, or why Bitcoin was created, why the blockchain is important, why ledgers and public open ledgers are important. Looking at those things and then looking at some of the things that have been proposed, it's like, well, that looks good, that sounds good, but at the end of the day, is it really benefiting the people, or is it benefiting the government more so? Because any system that you create and put into place should essentially benefit the people, but we know that governments are also going to want something out of it at the end of the day. So this page, this is actually starting to talk more about the CBDC, and they're talking about now how it would fit, testing of it, creation, the actual creation of it, and goes into more of those things that I kept saying they talk about it later. So today, federal notes are the only type of central bank money available to the public. That's what we showed and talked about earlier on some of those earlier talking points. So as a liability of the Federal Reserve, however, a CBDC would not require mechanisms like deposit insurance to maintain public confidence, nor would a CBDC depend on the backing by an underlying asset pool to maintain its value. A CBDC would be the safest digital asset available to the general public with no associated credit or liquidity risk. So essentially, we're getting a digital version of a fiat, essentially. So they're literally at this point setting the foundation for how they're planning to look at this and how they're planning to implement this going forward. So it's also telling you about the design, the not so much the look, but like how they plan to implement it. Like what are the fine details of this going to be? It's going to be privacy protected, intermediated, widely transferable, and identity verified. So privacy protected, that's obvious. They want to make sure that your privacy is protected. Also make sure that it's safe from loss, theft. So maintaining those consumer protections. Intermediated, so being able to have someone there to kind of oversee, provide some type of oversight. Widely transferable, that goes back to the point of being able to transfer it not only citizen to citizen, but cross borders, from you to like your family overseas or whatever the case may be. And then identity verified. This is one of the things that cryptocurrencies don't necessarily have right now. They do, but they don't. Like, someone by their wallet address. So you know them by a string of characters. as opposed to knowing them by their name. So this is the KYC verification, essentially. We talked about this a little bit on the last Zoom call, like where I was giving the example and telling you of my family and friends overseas, now needing to do some type of KYC verification to interact with institutions like PayPal overseas to do transactions. But they don't have, they're like the underbanked in the United States. Not so much they don't have access to banking services, but their banking services aren't set up and structured like ours. So they don't get paper statements or things with their names on it and an address. Those are things they have to physically go to the bank for. And for some people, that's like an 8-hour drive to get to a bank. Or, you know, if they don't have a car, that's a walk and they have to walk to the bank. So, you know, in some areas it's really hard, but they're hoping that CBDC can alleviate some of those issues. And I don't understand how, I mean, I do, but you know, the KYC thing, here they give their whole explanation, money laundering and terrorism. And I'm like, money laundering and terrorism has been done with US dollars and briefcases for decades. And whatever. Moving on. All right. So providing the general public with broad access to digital money that is free from credit risk and liquidity risk. They mentioned that earlier. So here they're just kind of expanding on those points. I just highlighted the actual paragraphs at this point because it's worth actually going through just reading it on your own. So it's to cross-border payments. That's the whole international thing. Support of the dollar's international role. Out of all the talking points that they could have talked on, this is one of the ones that is like super important because we often forget. It's so easy for us to say, I hope the dollar goes to zero or the dollar is going to zero. We forget how devastating that would be, not to the major players that we often talk about, China, Russia, you know, even Europe sometimes, like it's the smaller countries that would get hit hardest. And it's a lot of these smaller countries that have debts to China, to Russia, that they're trying to pay off. And as our dollar continues to fluctuate in value, that changes their timeline for how they're going to be able to pay these things off. Also, our dollar losing its solvency also changes the solvency of other currencies. So the euro, where Europe has traded a lot of their gold for US to back, hold, and preserve value of their system would go under because our dollar went under because they're holding a lot of our dollars, they're holding a lot of our treasuries, a lot of our bonds. So not only there, but Japan, you know, name a country, they're holding our dollars. So the United States has a huge role in international trade and international stability of a world systems. So that's that. Financial inclusion, just trying to make sure that everyone can be included in the system, making sure that lower income households are brought in and can actually be able to participate fully in the financial markets, extend public access to safe central bank money. Sorry. So here they talk about cash, but at the end of the day, cash is losing its glitz and glamour status. So I highlighted some talking points that they brought up in this paragraph. So the United States use of cash fell from 40% in 2012 to 19% in 2020. In Sweden, the use of cash fell from 33% to 10% to less than 10% in the same period. And then China, 50%, all the way down to like 13 or so, but that's point of sale payments. A lot of what they use in China right now, they actually transact through apps like WeChat. They have another one that's really big. So when you walk up to a stand, you just scan QR codes now and the money comes out. Like a lot of people don't even carry a wallet anymore. They just carry their phone. They have their ID. They have passes to get into work. They use the NFC technology to scan to get to wherever they need to go, bus, train, whatever the case may be. So essentially that whole section talking about how there is a decline in the use of money, not only here in the United States, but globally. Potential risk and policy considerations. So they literally go through and talk about a lot of the things we just talked about earlier. So changes to the financial structure within the markets. So shifting away from having low assets being available, credit availability, the rising cost of credit for businesses, safety and stability of the financial system, the efficacy of monetary policy implementation. So in this first sentence here, it just says in this framework, the introduction of the CBDC could affect monetary policy implementation and interest rate control by altering the supply of reserves in the banking system. So they really do go through and highlight concerns and talk about why these concerns are there. Also privacy, consumer privacy, and then financial crimes. Resiliency and cybersecurity. So literally this section and then this whole section here is all one and the same for the most part. So seeking comments and next steps. This is that part where I told you they were seeking information from the general public, and they want to know from businesses, from people, opinions. So there again, this word comes up, stakeholders, all stakeholders. Anybody who's going to be using this is a stakeholder. If you have money in your pocket right now, you're a stakeholder. If you have money in the bank, you are a stakeholder. So they want information. They want to know, like, they want questions answered. They want to know like how you feel, what are your thoughts, do you need more details? Then they also have questions that they're going to be answering. Answering here. This is the link for a form. And then they also have like this huge public forum that they're going to be doing. So the other thing that they're encouraging people to do is go through, read this, answer some of the questions, and talk to your local politicians, your congressman or woman about this, because at the end of the day, they're the ones who are going to be able to go get in the face of Congress. They are Congress. So they're going to be able to like literally voice your concerns because you vote for these people. So talk to them. Most people vote for a person, never attempt to reach out to their office to voice their concerns about nothing ever. It's like, oh, I voice my opinion by voting. So now hopefully this person is going to do everything that they said that they were going to do. But like, you have to tell these people what you want. And a lot of times the politicians just end up doing what they want, which upsets the people, but they don't have any feedback. Then, what else are they supposed to do? So this sums it all up. at the end. And then there are papers here, event and the references. Some of these are good to look at too. Talks about access to money and payment services, how a typical payment service works. So looking at that would be cool. Federal Reserve notes, how they get circulated. That's really cool. So it sums up and talks about a lot of those financial services that we don't really think about in depth. But when it comes to talking about a CBDC, trying to transfer to a digital system, like all of this stuff is going to be super important to really understand. So yeah, some of this is like, it looks kind of crazy because I just typed it out, or I wrote it out on my screen earlier when I was just thinking about things to talk about. So I'm gonna go over the Forex Factory calendar with you guys, and I also pulled up some of the papers that they talked about. So really quick, how much it actually costs when they talk about cross borders and transferring money over person to person or government to government, how much it actually costs. There's a whole paper on that from the World Bank. This is one of the previous papers that they referenced, just assets and liabilities of commercial banks in the United States. Is kind of an interesting read. This paper also, it's 116 pages, but it is very interesting to read the role of central bank money and payment systems. This was one of the earliest papers. So if you go through and look at the references for the paper they just released yesterday, this paper right here came out in 2003. It actually talks about digitizing central banks, payment systems, how to make them flow better. But we know for a fact that it's not the earliest paper that the government has on central banks, because we know that the NSA has their paper, which is there. And the earliest reference in the NSA paper is like 1985. So they were talking about digital currencies back in 1985. Don't let anybody fool you. All right. So this week, now just kind of talking about news, how this is going to relate to us, was another meltdown. This first 3 weeks of the year have all been negative weeks for the stock market. Also been kind of weird for currency markets as well. Markets are just kind of folding at this point. There's a term that they use to talk about the economy, and it's a rollover. And that's essentially like, if you talk about it from a financial standpoint, where you're starting to now take profits and you're starting to, the economy is just rolling from being a economy of profit to now being an economy of bearishness, kind of hold, wait and see, but then also having a lot of fear coming into the market, where people are rolling from one asset class to another, or just rolling out of the market completely. And then that causes the entire economy to roll over. Think rollover, play dead, or rollover and, oh my gosh, it is dead. Whenever you think rollover, because money is literally being squeezed out of the market. If you think about it being a towel, starting at the end of 2019, going into the beginning of 2020, just think about a dry sponge and you like putting it in a plate and just pouring water on the plate. That sponge is going to soak up a lot of that water. And then you're going to get to a point where that sponge can't take in any more water and the water is just sitting there. and it's just going to sit there. And then eventually, like, okay, Sponge isn't doing anything anymore. You need to do something more exciting. You need to do something to kind of clean up what's going on. So you need to wring the water out of the sponge to then soak up the rest of the water that's left over. So that's essentially what's going on in the market right now. How do I know? The Fed has actually, on yesterday, when they released this paper, also talked about how money is now coming out of bank accounts. So that whole spiel we talked about before, where I said that eventually people were going to get to a point where they were going to have to use their money. Sorry. A lot of that came out yesterday. During the World Economic Forum. It also came out when Christine Lagarde spoke today. This isn't just happening in the United States, it's also happening around the world, where now all of this money that was given in stimulus is now needing to be reabsorbed back into the marketplace. So we often talk about what things are going to trigger the next thing. People came out of the job market last year with no intention of going back into the markets because corporations don't treat them fair, not getting enough money, don't have best benefits, don't have enough time off, whatever the case may be. So they're the most at risk, according to the Fed. So yesterday, the Fed stated that those are the people who are most at risk because at some point in time, the unemployment benefits are going to run out. And when those unemployment benefits run out, then you are going to have people using their savings, which they highlighted that people are actually using more and more of their savings now, even compared to the first week of the year. So when that money runs out, people have a crossroads. It's either don't go back into the workplace and you become a liability to the system, or you have to go back into the workplace. But another thing that the numbers for the unemployment claims yesterday highlighted was that, first of all, we had more people filing for unemployment claims. These were people dropping out of healthcare, and these were people dropping out of like services markets, like fast food, restaurant service. So people were dropping out of those two industries at really high rates. And what this paper also, or what the report actually highlights more so than anything other than that, is that we are actually near full employment. You would wonder why and how that could be possible. So after 2008 happened, we lost millions of jobs. To this day, we still never got all of those jobs back. Like even before COVID, we never had all of the jobs back that we lost in 2008. Now, after COVID, we still don't have everybody back in the job market, but this paper highlights the fact that we're near full employment. How? How are we near full employment if we haven't recovered COVID jobs and recession jobs? It's because companies are pivoting away from using people. So that whole AI, digitizing a job, erasing a job, and streamlining, corporations are now showing, and the Bureau of Labor Statistics has proven in this last report that companies are able to do that, showing that we're near full employment, which is shocking. A lot of people didn't think or would not have thought that we would have been able to transition that. It only happened in like a few quarters, but it did. And then today, Janet Yellen spoke, Christine Lagarde spoke. I watched Janet Yellen speak for like 5 minutes and she bored the crap out of me. So I ended up reading the rest, and it wasn't anything that we necessarily haven't heard before. But next week, I don't expect anything too glamorous out of the market next week, because next week is Fed week. Next week is a lot of manufacturing and services news out of the United States, out of the Euro, out of the UK. We get CPI numbers from Australia on Monday. Tuesday, we get consumer confidence, which I don't expect for it to be all that confident. Wednesday is Fed Day, which it's Fed Day. So we get our Fed statement. We see if the Fed is actually going to change rates next Wednesday, which I don't think they're going to change rates this early. If they do, that would not be great. Not be great for the markets. But if they did, I mean, whatever, we already know how to trade in times like this. And then we also get our press conference. We get CPI news from New Zealand. On Thursday, we get GDP news from the United States. We get core durable goods numbers from the United States. We get unemployment claims. We get pending home sales. And Friday, we get CPE numbers. We get consumer sentiment numbers from the United States. So next week, every economic indicator that would tell us anything about the United States comes out. I'm laughing because, this year has started out the way that it has, and next week is just going to be the icing on the cake to a very bloody month. Cryptos, it was one of the things that I had written on this sheet. So crypto meltdown, it erased $1 trillion out of the market. Why? There is a why, there is an answer to why that happened. And to know why, you have to know your correlations. So if you don't know your crypto correlations, if you don't know how cryptos, period, correlate to the US monetary system and everything within the US monetary system and the US stock market, if you don't know the correlations, then I suggest you take this up as your weekend homework and figure it out, because that's super important to know going forward. I also wrote down and highlighted this point, Intel bringing semiconductors. They're actually building a factory outside of Columbus, Ohio. That is going to be super important going forward for jobs, and also to help our manufacturing numbers here in the United States, and to also help keep us out of the mess that we currently have ourselves in here right now. One more thing and I'll be done. So oil numbers are they're looking kind of weird right now. They slid. So we did get crude oil inventory numbers, and crude oil numbers were not all that great. They're starting to hoard oil again. But I'm going to pay attention to oil because there was some news that came out about Russian supply and about Brent supply coming out of Europe, and a potential flood in the market coming. So there could be some manipulation happening in the price of oil. Also, if you look at the DXY for, you have to take it out a long time. So I think you have to take it out to about 10 to 15 years or so and look at the chart. The DXY just crossed over a super pivotal point, and it's consolidated over that point now for the last several months. So we've had a quarter of consolidation over this level. That's really going to affect oil as well. If we continue to see the DXY go up, especially if the DXY shoots up with interest rates changing and overshoots 100, which is definitely possible. That could possibly cause a little bit of panic in global markets and then also cause a panic in the oil markets, which would be a great opportunity for other countries to step up and try to overtake the US dollar as being a controlling factor in oil prices, and then also suppress the United States when it comes to our production and how much we can actually contribute to the system. That wouldn't be good because this is an election year. And so all of that happening at one time wouldn't necessarily be great for the Democrats. I only say that because we know how many seats they hold, what areas of government they hold. So they have the most to lose this year. So anyway, that's that. Sorry for the long fundamental session, but I definitely wanted to go over that paper, show it to you. I'm getting ready to drop it in the group chat now. I'm going to turn it over to Mr. Level so he can do the technical wrap up for the week. Thank you for listening.
Thank you, Carmen. Great information as always. Appreciate everything you bring to the team. Jump in these technicals. Looking at the DSY, we can see that we did get the push up off of the level at the beginning of the week. We did come back up to retest previous structure and we held there today. We did not get a break of that, but being with everything that I'm hearing from fundamentals and just looking at price action, depending on how the markets open up Sunday, we could very well see the dollar break above this structure. And as you heard Corman say, we could very well reach $100 price target for DXY. That would be right here at this structure, which is the next imbalance to be filled in. So we could very well see the DSY inflate and push up to 100 easily. However, could very well see the dollar hold this structure and come back down to retest this low that it just created. And we could see it break back down to the downside. We know that fundamentals will let us know where our technicals are going. So with the news, with the fundamentals next week, with the news coming out, we have to see what happens with interest rates and everything, and see where that pushes the market. Um, So with that being said, looking at our trades for the week, our currency pairs, we know that our currency pairs inversely correlate with the dollar. So when we see our dollar push up, we know we're going to see our currencies push down. We did get a good sale in Euro USD this week, over 100 pips. GBP USD almost 100 pips. NZD USD over 100 pips. So with our currency pairs this week, there was an opportunity to catch 300 pips if you traded all three, or at least 100 pips if you traded one. That's great pips for the week. So looking at our metals, I got it drawn out from earlier in the week. You see that I wanted to see silver push up to retest this structure, and we got that move. Looking at gold, I also wanted to see gold push up and retest this structure because we know, like currencies, our metals move in the opposite direction of the dollar. So we see that our levels was hit, retested. And so now, we'll wait and see how the markets open up next week, and we will trade accordingly. Looking at oil, we have to see what news we get next week. According to what Corman said, oil is, looking fundamentally looking crazy right now. Technically, it's at the top of a structure and level that it just broke. So we'll see how that works when the market open. If we hold this level, y'all already know we got $100 price targets for oil. If we break back below this structure, we could come back down to retest 78 or $75. Looking at U30, last but not least, told you guys if we broke this structure and got a good retest and didn't break back above it, price had nowhere to go but to retest previous low, previous structure. And I told you guys that we could potentially come down to retest previous lows, and we see that's exactly what happened. So with that being said, technicals is always on point, fundamental is always on point. At this time, I'll start the recording and take any questions.